stepping over the declarations page, stepping through the definitions page, now we're going to get to the coverages. So this is the insuring agreement, all right? This is what a lot of people think of as the actual policy, right? No, it's not. The policy is the entirety of the documents, but basically, this is the crux of the matter, right? You take a look at it, it'll say, page 1 of 15, and page 1 of 30, 1 of 20, right? So that is all of, the insuring agreement. That's really the agreement between the insured and the insurance company. Okay, so it's important to know what's in there. And basically, what you're dealing with here is the insuring agreement is going to break into the coverages in detail and then the exclusions, which we will get to in a minute. Now, endorsements are usually found at the end of the insuring agreement, but really the insuring agreement goes after the coverages. Now, again, like I said, we're not going to get into Section 2 liability. There's a lot of that in the insuring agreement, but we're going to focus on Section 1 property damage, right? And so what that comes down to is the coverages, A, B, C, and D. So let's talk about each kind of in part, and I'll tell you what it is, give you an example, and tell you, basically 3 things you need to know about it. So let's start with A. So coverage A, like I said, that covers your dwelling, right? So when most people think of insurance and they say, okay, well, it's my home, you're right, okay? That's going to be coverage A. And again, it's also going to include attached structures to your home. So if you have a garage attached to your home, that's going to be covered under A. All right, so what's an example? Okay, well, a fire rages through the hills and it burns down your home. Okay, well, you're going to make a claim under coverage A. All right, that's it. Now, what are a few things you need to know about coverage A? Well, first and foremost, it's a common area of first-party and third-party claims. And if you think about it, that makes sense, right? Because if there's a loss to your property, whether it's a natural loss, and so you may be dealing with a first-party claim, or it's caused by the negligence of a third party, so you're dealing with a third party claim, the fact remains that in most cases the damage is going to be to the insured dwelling, right, to your home, okay? So you're really going to see most, if not all, disputes focused on coverage A, the damage done to the dwelling. Now, this is something that I want everybody to pay attention to because this is important. Now, coverage A, I don't know the exact numbers. I know you can Google it. I do know that it's over 50%. So over 50% of all homes in the United States are underinsured. Now, what does that mean? Okay, that means that there's not enough insurance to cover an insured in case of an entire loss, right? So here's an example. So let's take this example of a fire, raging down and burning up the property. Let's say your coverage A limits are $200,000, right? The fire comes, it destroys your home, complete loss. So you turn around and you want to get the policy limits at $200K, but you realize that the actual loss is $300,000, right? Because your home was uninsured or underinsured. So what do you do in that instance? Well, you hope, that you get the best case scenario, which is to say you get the policy limits of $200,000. But that's not even a given, right? Because you're going to have to eat the $1,000 deductible, and there may be some other reasons why the insurance company doesn't just come out and cut you a check for $200,000. But even if they did, you're still underinsured by $100,000, right? So that's a huge loss. And so it's so important to make sure your home has adequate insurance. I'm not going to go, there's a whole mathematical formula about the square footage. I'm not going to go into that. I will say that myself, I recently looked at our homeowners policy and realized that we were underinsured. So I went and I made the appropriate changes, which is to say, I called the insurance company and said, okay, I want higher limits under my coverage A, right? And that should take care of the situation.
The first code is
688.
The first code is
688.
The other thing I want to mention about coverage A is that you want to avoid what's called market cost, and you want to get replacement cost coverage. All right, so what do I mean? So normally, with coverage A, you're going to have market cost, right? So in the event of a total loss, that means what does a market say, the value is, right? But you may not want that. I recommend you get replacement costs, which happens to mean that what will it cost to replace the home in the event of a loss, right? So that can, not always, but that can help offset any issues you may have with underinsurance dealing with coverage A. So that's really all there is to say about coverage A. So let's switch gears and talk about coverage B. So like I mentioned when we had the discussion about the declarations page, coverage B covers other structures, right? But remember, it's other structures unattached to your home. And structures has a broad definition, all right? So it means a fence, okay? It means a pool. It means an unattached garage, right? It could mean a shed, okay? It could mean, a granny flat, all right? So that's what coverage B is going to cover. Now, let me back up. Let me give you an example of that. So let's just say that wind comes down and it picks up your fence and throws it in your neighbor's yard. All right. If that happens, so what you have then is a claim under coverage B, right? Not anything else. If all the wind did was picked up your fence and threw it out, you don't make a claim under A or anything else. You make a claim under B, subject to the coverage B limits. All right. Now, few things to keep in mind with coverage B. One is that usually coverage B limit should be 10% of the coverage A limit. So for example, you have coverage A limits of $200,000, your coverage B limits are going to be $20,000. All right? Now, why is that important? Well, it's important because of this. It's a common area of first party and third party disputes, right? For the same reason that, coverage A is, right? If you have damage to your dwelling, chances are you're probably going to have damage to the other structures, right? That, if a fire comes down and burns up your home under A, chances are it's going to burn up the granny flat, right? Covered under B. So they usually kind of go hand in hand. There's only been a few times where I haven't seen them go hand in hand, so that's something to be mindful of. Now, let's talk again about underinsurance, because the status quo basically, again, is like I said, is to have coverage B limits to be tied to coverage A, and they should be 10% of coverage A. In most cases, that's accurate, right? I think that's what we have in the case of our home, so not really much thought there. But here's what could be a problem. Let's say you have a granny flat, right? And you spruce it up, you make it really nice, right? You've done some work, you've added some plumbing, et cetera, et cetera, et cetera. You have your in-laws come and stay, your college friends come and stay. It's a house unto itself, right? So you did a really nice job. Well, if you would have left the policy as it is, that would have meant that that the coverage B limits would be 10% of your coverage A limits. Maybe your coverage A limits are fine, but let's say that fire comes down and it burns up the home, $200,000 loss, so you get your $200,000, and it burns up the granny flat, right, which is insured for 10%, which is $20,000, but it's going to cost you $60,000 to rebuild it back in the condition what it was, right? So in that instance, again, you're dealing with underinsurance. And again, I keep bringing this up because it's so important, right? And so many people are simply unaware that their home is uninsured. And we're going to be seeing a ton of that in the California wildfires, and frankly after Houston and a hurricane and everything else. So it really is time, personally and professionally, to do the due diligence and make sure that your home has adequate insurance, right? So you got to look at coverage A, you got to look at coverage B. Now, C, sometimes it matters, not so much. D, not really going to be an issue. Definitely for A, definitely for B. So, yeah, I'm done. So now let's switch over to coverage C. All right, so like I said, discussing the declarations page, coverage C covers your personal property. All right, so that's your stuff, okay? It doesn't cover your auto, all right? That's covered by your auto insurance. But it covers all of your personal property. So your books, your suits, your pots and pans, your dishes, your furniture, things like that, okay? So that is what coverage C is going to cover. So what's an example? Again, if you have, let's say that neighborhood kid is playing with firecrackers, a firecracker shoots off into your window, lands into your living room, burns up the carpet, burns up the couch. Okay, well, you're going to make a claim under coverage C. All right. Now, that could be a third-party claim too, but let's not get ahead of ourselves. At a minimum, you're going to make a claim under coverage C because your personal property was damaged. Okay, so what do I need to know about it? Well, again, common area of first-party and third-party disputes. I just kind of gave you an example of what could potentially be a third-party dispute. So you need to be aware of that. For the same reason, if you're dealing with A, you're dealing with B, chances are if the structure and any unattached structures were damaged, that the personal property in the dwelling and unattached structure were damaged as well. Right? That's common sense. So you're usually going to have A, B, and C together in that regard. Now, I want to be clear here because coverage C is not as simple as it appears to be. In fact, it's a fairly complicated area because you're dealing with the issue of depreciation. All right, so I want to talk about this for a minute. So here's an example. It's somewhat a ludicrous example, but I think it'll make sense. So let's say you have a $10,000 couch, leather couch you imported from Italy. All right, just a nice couch. All right, so you've had it for 10 years. All right, you've taken care of it, but you've had it for 10 years. Fire comes down, that fire from the hills again, burns up your property, burns up the dwelling, burns up the couch. All right, so you're making a claim under A, you're making a claim under C. The adjuster comes in and says, okay, well, I see you have this nice couch. And you tell them, oh, yeah, it's, top of the line, right? I got it in Italy, it's imported, real Italian leather, the works, yada, 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 pay $10,000. You're going to say, oh, well, that's nice. Well, how long have you had it for? And you're going to say, 10 years. And he's going to say, okay, 60% depreciation. All right, here's a check for $4,000, right? And you're going to be saying, what just happened here, right? So you need to get a grip on depreciation. And there's something that I want to point out. Now, what insurance companies and adjusters do is usually this. They go in and they'll say, okay, you're making a claim for all this personal property. How old is that personal property? Right? You got that suit. How long ago did you get that suit? You got that couch. How long ago did you get that couch? You tell them, and then they're going to come in and reduce the value of the property based on depreciation. They're going to say normal wear and tear. Now, I get that, okay? And intuitively, that makes a lot of sense. But here's the problem. The problem is that's not the standard. The standard is what's the condition of the item, not what the age of the item is. Now, again, I understand what insurance companies are doing because 9 times out of 10, right, the condition of the item is directly related to the age of the item, right? So, because think about it, it's your normal wear and tear, right? So as time goes on, you're going to use this personal property more and more, and so things are going to be, there's going to be some level of deterioration. Well, that makes sense, right? And maybe that makes sense in the example of the $10,000 couch. But that rule doesn't always make sense. So take this example. Let's say that when you're in Italy and you're busy, buying up these ridiculously priced couches, you said, look, I see this fantastic tuxedo at Milan, $6,500. You buy it, okay? Now, you go home, you put it in your closet, you put it in the tuxedo bag. You have it for 10 years, all right? Now, you only wear it to black tie events, right? And so you have the black tie events every 2 years, right? So you go to the black tie events, you don't spill any wine or whatever on it, right? You go home, you take it off, put it back in its package. You do that 5 times in a period of 10 years. You never even dry clean the thing, no stains, right? So, raging fire comes down, burns up the property, burns up the Italian couch, burns up your Italian tuxedo. The adjuster comes in and he says, okay, well, tell me about what you had in your closet. And you say, well, I had this nice $6,500 tuxedo from Milan. And they're going to say, well, how long did you had it for? You're going to say 10 years. And he's going to say, boom, I'm taking 60% off depreciation. And you're going to say, no way, right? Why? Because you're going to say, look, that thing is basically brand new. I took such good care of that tuxedo, right? You have to pay attention to the condition of the item, not the age of the item. Now, again, I bring this up because, again, a lot of times insurance companies are right by taking that depreciation, but I just want everyone to understand that depreciation needs to be based on the condition, not the age of the item, all right? Now, here's something to keep in mind with depreciation, and this is the last thing I really want to say about coverage C. Now, coverage C is an endorsement I recommend you get, and we'll get to endorsements in a minute, but basically I would recommend you get an endorsement which is what's called replacement cost coverage, not actual cost coverage. So what that means is this. Let's say you have complete loss under coverage C. That's $30,000, where the insurance company is going to come in and say, okay, well, you got $30,000 of, that's what's going to cost to replace some of the property you have. But if you have this replacement cost coverage, you're going to step in and say, okay, well, I want the money it takes to replace my items, right? Not the actual cost, because actual cost means depreciation, right? So the adjuster, again, can come in and say $6,000 off, 60% off, right? And you're going to be stuck there and saying, oh my gosh, right? But if you get this replacement cost endorsement applicable to coverage A, you push back and say, no, it's going to cost me $12,000 to replace that $10,000 couch, right? It's going to cost me $8,000 to replace that $6,500 tuxedo. So that's something you want to keep in mind. And frankly, look, these are ridiculous examples. I don't have a $6,500 tuxedo. I don't have a $10,000 couch. But I want to bring this to your attention because it's important to understand depreciation and the ways to avoid it. Because when you're dealing with a loss, and I speak from experience and working with clients, you don't want to have these nasty surprises, right? And you think you'll be entitled to something, but you're not because you didn't read or you didn't understand the contract. All right? So let's wrap this up with coverage D. Like I said in the beginning, it's a mouthful. So coverage D, ALE, additional living expenses, loss of use. So what does that mean? Okay, well what that means is additional living expenses. So let's break this down. Additional means it's an increase, right? It's not your mortgage. It's not your rent, right? But let's say that there was, again, fire comes down from the hills, burns up your property. Your property is going to take, 3 to 6 months to be restored. So where are you living at that time? You can't live at your home, right? Well, chances are you're renting a hotel. So that is an additional expense, right? Because you're paying for your mortgage, right? That's not going to be comped under ALE, but the monies you're paying toward the hotel is arguably going to be comped under coverage D. They are additional. They are in addition to what you're already paying. Secondly, they're living expenses, right? So living expenses is going to be shelter. Like we said, the example of the hotel, it's going to be food, right? It's not going to be, your new tuxedo, your new Italian couch, right? You're not going to get that. It has to be a living expenses. Now, sometimes you could get mileage for gas, right? Because let's say the hotel is 40 miles further away from your work, and so now you have a longer commute, you have parking tolls, et cetera, et cetera. Well, you can make an argument that that's recoverable under D. But basically, it's additional, so an increase of the living expenses. And frankly, this isn't a common area of first or third party disputes. It can be, right? And I will give you 2 examples when we get to disputes in a minute, because I think they're important examples of ALE, but basically it's not really common. So let me wrap up the coverage piece talking about peril. So what's a peril? Okay, a peril is a cause of loss, right? It's basically some type of natural occurrence that happens to the property, lightning, fire, wind, right, flood, okay, that's going to affect the property. That's a peril. So what you need to be aware of what's a covered peril. So when you look at these policies, there are really kind of 2 types here. There's what's called an all peril policy and a named peril policy. So let's break these down. Well, an all peril policy is actually a misnomer because it doesn't cover all perils, okay? What an all peril policy covers are all perils but the perils that are specifically excluded under exclusions, all right? And we'll get to exclusions in a minute, but that's really important to keep in mind because a lot of people get confused, right? Because they're going to say, oh, well, all peril, that's going to cover all perils. It's not, all right? The other one is going to be a named peril, and it's almost like the opposite of an all-peril policy. A named peril is only going to cover the perils that are named in the policy. And frankly, that's the more common one is going to be an all-peril policy. Sometimes you'll come across a named peril. If you have a named peril policy, what you need to do, even before there's a loss, is go to the go to the exclusions and say, okay, what's a named peril, right? Because that is the only types of perils that are going to afford you coverage under the policy. So you better know what they are. Flip side, dealing with all perils, you better know what the exclusions are and hope that you don't have one of those occurrences that are excluded under the policy, because if you do, there's no coverage. All right, so that's really it with the insurance agreement, coverages and perils.